We seek, during this presentation, to give you a snapshot of the state of the world and its investment implications. From this global backdrop, we drill down into the South African investment condition. In doing a global investment health check, we look at the outlook for economic growth, what it means for earnings, inflation, and interest rates. This helps us to assess the relative investment merits of various asset classes. Global economic growth is looking pretty good at the moment, and it is indeed above trend in many developed nations. This economic vitality has underpinned strong corporate earnings growth, which, together with relatively low interest rates, or discount rates as we call them, has boosted valuations of growth assets such as global equities. This growth is, however, resulting in some upward price inflation pressure, which will in due course result in a rise in interest rates. Rising interest rates are typically not a problem for asset prices as long as growth remains robust. We are, however, picking up some early economic indicators which suggest a deceleration in the pace of economic growth towards the latter part of 2019 and beyond. A key risk to growth assets are higher interest rates and a decline in earnings growth momentum. Growing trade tensions could also contribute to risk aversion. We have become a little more cautious given this outlook. A further issue that is dominating the investment landscape is a rampant US dollar, which has resulted from a growing discrepancy between the growth rate in the United States and the rest of the world, which in and of itself have been showing indications of some softness in leading indicators. Emerging markets have also been suffering from a lack of US dollar liquidity as the United States hoovers up excess capital in the rest of the world. From a South African perspective, the Ramaphosa honeymoon looks to be very much over, judging by the reversal of foreign portfolio flows. After recovering early in the year, business confidence is again softening, and the rand has weakened back significantly. We show that while there is significant growth potential in South Africa, this is very much dependent on structural reform, and it is crucially important that this happens. From a local asset class valuation perspective, local real yields, after very significant weakness, have become quite attractive. Local listed property, also after some significant weakness, have risen to very attractive levels. Local equity markets have been weak of late, but price to earnings multiples are a lot less demanding than they have been for some time. A number of South Africa incorporated and rand hedge shares retain investment merits in our view.